So some 2 weeks ago, I received a Substack update from Rosaline Investments, where she basically outlines her perspectives of the current market conditions today, with a very intriguing and interesting title, The Confetti Phase of the Market Cycle. And as a true investor myself, I'm going to shamelessly clone this interesting topic idea. And from that Substack post, I think the general market, which is identified with the S&P 500, has continued to record new highs. And I believe, given the current trajectory, she might need to prepare a lot more confettis to come. And here's the current state of affairs. Stocks, home prices, Bitcoin, gold, money supply, national debt. Everything is at all-time highs. The CPI inflation rate is 4% per year since January of 2020, while the Federal Reserve is ready to cut interest rates next month. What a time to be alive. But to gain more perspective for this topic, this is a TLDR of the piece from Rose. And it could be summarized into these few key points. First, I think a lot of people around us, they are seeing their portfolio clocking in new highs, and many of them have clocked in incredible gains for this year. And this will inevitably result in a greater group of people building in a false sense of skill. Second, she threw out a rhetorical question asking what business truly deserves to go up 300% in a year. And by extension, I think you can probably guess which company she's talking about. So while everyone is flexing their returns, it's worth remembering that holding a $200,000 Palantir position that started with $5,000 doesn't make a genius. While holding a 20 bagger is impressive, but if they had so much conviction in their skill, it wouldn't have just been a few $1,000 bet to begin with. The third point is circling back to the idea of being greedy when others are fearful, and vice versa, being fearful when others are greedy. And I think it's pretty safe to say that at this current state of the market conditions, there are quite a lot of people that are being greedy. The fourth point, interestingly, she quoted Vladimir Putin saying that when two tigers fight in the field, the smart monkey sits and watches how it ends. And currently, in today's market, there are plenty of tigers now, so it pays to watch. And the fifth point, to summarize the entire article, is that this is not just about missing out on the next big thing, but more so protecting your capital today so you can still be in the game when the next real opportunity comes. So before I actually provide my own commentary, I think feel free to leave your own thoughts about the current investment market cycle today and at which state or stage do you think we are currently in. So do you know that the $2,000 sitting in your bank account today could be working way harder for you? And Longbridge, a MAS licensed broker in Singapore, has a promotion running right now. And if you sign up with my link below and deposit just 2,000 Singapore dollars, here's what you get. A 6 plus 6% per annum interest boost on your first $2,000 for 90 days, exclusively through my link. And that's $60 in interest if you park the cash in their Cash Plus product. On top of that, you get an additional $18 cash coupon just for signing up and depositing. And if you hold your funds for 30 days and complete 3 buy trades, you'll receive half an Nvidia share worth about roughly 100 Singapore dollars today. And add that up, and you're looking at around $178 in value on a $2,000 deposit. And that's 8.9% before you even start investing. So you also enjoy lifetime commission-free trading for US, Hong Kong, and Singapore stocks. 0 platform fees, and if you've got more capital, rewards can go up to $800 in total just for getting started. So don't miss this out. Click on the link in the description below to grab your exclusive rewards. And thanks to Longbridge for sponsoring this video. So here are a few of my responses to this Rose piece. I think it's generally a pretty sound article that shares her perspective very clearly, but I don't think it's necessarily something that is very evidence-based or very deterministic. In fact, I do think that it throws out a lot more questions as a reader than answers. So I think first things first, she made a very broad-based claim saying that a lot of people seeing their portfolios going up and it builds a false sense of confidence of skill. Then later on, citing a lot of all these Palantir buddies. And this is a complete speculation on my end, but I do believe that a lot of these people that are flexing their portfolios that are full of Palantir stock are mostly congregated either on YouTube or on X.com, which is formerly known as Twitter. And I think social media as a platform has a certain self-selection bias mechanism. And the algorithm is best at understanding what you like and dislike and then target you specifically. And by extension, if we follow that set of logic, it might not be extremely representative of the entire investment world where you see a lot of people experiencing a lot of gains. There is probably a good half of the other investment crowd that didn't do as well or did something extraordinary to get very different results. And also not forgetting the fact that specifically on a lot of all these social media accounts, they are naturally a lot more braggy. So unless you are able to kind of like aggregate all the data across different postings, or if you are Fidelity today where you have access to all the retail accounts, then I think you can make a definitive conclusion. If not, right now, I think this is purely just anecdotal and based on your algorithm feed. And for those that are not doing well, maybe firstly, they're not even posting their losses. And secondly, even if some of them posted, it might not have landed onto your own page because it doesn't drive engagement and it didn't went viral. So that's the first assumption that I wish to square away. So moving on to the second point that I wish to kind of debunk is that I do believe a lot of people that are investing in the market probably have heard of the famous quote about being greedy when others are fearful. And clearly, I think in today's market climate or condition, I wouldn't say that we are overwhelmingly greedy. It's true that people are a lot more carefree, a lot more confident, but that does not give you a definitive conclusion into saying that, oh, the market is definitely overheated, it's going to crash in the next 6 months. It might be overheated, it could potentially get even more overheated, but I think the more important question is this. So yes, we see this as a spectrum. We are definitely on the more greedier side. But what can we do with this specific information? How should this information guide our own investment process or decision? So do we sell everything and hold on to cash and just hoard? Do we trim off a little bit of our portfolio? Which stocks do we trim? And if we do trim, how much do we trim down? 20%, 50%? And then of course the ultimate question, when do we actually get back in? Is there a time frame? So the long and short of it is this. Even when bestowed with this very critical and important information, it doesn't guide us in any shape or form that is both definitive and also replicable as a process. And if I can conclude, this is at most just a feel-good discussion. And the third point that I wish to draw about is really this very interesting analogy of some sort, saying that two tigers are fighting in the field and the smart monkey actually sits and watches on the sidelines. So by saying that, or by quoting the smart monkey sitting on the sidelines, does it mean that you just stay invested and just continue on with your life? Or does it mean just selling everything and holding on to cash and wait for the next big opportunity? So that's the clarification that I need to make here. Because if you actually sell everything and try to quote unquote time the market, then I think that you are the third tiger in the field trying to fight it out, with one going extremely long and one going extremely short, trying to call for the top. So regardless, I think putting this discussion aside, I think it's more important to have clarity in terms of your own financial objective and your own investment plan moving from here. So for myself, as an investor in the markets as well, here are the three key signs that I'm currently looking at. I think firstly, it's really the idea of the fragility and volatility in general market movements. And I do identify this trend as picking up pretty quickly, and it might not necessarily be a good thing. So I think you can look at this from a few different perspectives. Of course, firstly is through the individual company and also from a general market point of view. So I think when you look at individual names today, so regardless whether they are small cap or large caps, they are seeing a much more significant movements of volatility in terms of their individual share price, especially during company announcements, company earnings, or new developments. And on a general market perspective, you are also seeing very huge volatility contingent on specific announcements or guidance from the Fed, CPI data, whatever prints and things like that. So for myself, when I see these sort of big movements, it just means that there are a lot of money being moved around very, very quickly. And it also kind of signals to me that a lot of all these players in the current market are feeling very lost. They don't really have a lot of confidence in the general market base. That's why a lot of hot money are flowing in and out and trying to speculate whether the market should move up or move down. And if we guess that conclusion, it means that the markets are increasingly become very unstable and investors are being very jittery. And the second sign that I'm looking at is the market sentiments in the offline world, not the online. I don't want that whole algorithm to self-select the different posts that I read. And I also believe that most of you probably heard of the shoe shine boy story before. When the Wall Street professionals are getting their shoes shined by the roadside, the person offering you the service is also offering you stock tips. So personally, on how I use this benchmark or yardstick, I think you also cannot self-select your own circle of friends, especially those that are very in tune with the investment world. Your fin bros, your Wall Street professionals, you should tune all of them out. In fact, I think it's more important to focus on things like especially your random encounters, your taxi uncles, the people that are in the service-based industry, or folks that usually don't even talk to you about investments, suddenly being very excited about them. Your friends, your relatives that are the furthest away from the stock market based on your own recollection. And specifically for myself, I think I can attest to the fact that there are more and more people talking about investing into gold, and it is one of the safest hedges or bets in the markets today due to its very significant rise and how many people have already made a lot of money from gold itself. And in specifics, when more and more people start to discuss speculative assets, I think that's also potentially a red flag. And the third sign that I'm looking at is more so specifically general market valuations and the rally, how deep and how broad-based in terms of the market breadth. And there are also many different ways in terms of how you evaluate whether the market is expensive or whether it's overvalued or not. But one most important thing that you should always keep a very important pulse on is really the state of earnings and earnings growth. So if company valuations are running exponentially while earnings are not keeping up, that's many signs of danger, and that should ring a lot of alarm bells. But I think for now, at least in the US markets, a lot of all these tech darlings or companies that are being bidded up are kind of supported by good earnings growth as well. So that's not necessarily a concern. The bigger concern would probably be companies that are not doing so well, but their stock price keep going up. That kind of disparity, I think, is a call for concern. Price to earnings, CAPE ratio, which is the cyclically adjusted PE ratio, equity risk premium, looking at the spread between bonds and equities. So I think there really isn't a quote-unquote right answer here, but it's just based on how you read the market. And of course, don't forget that this is a probabilistic nature. You can't say for certain that if the market reaches a P of 30, means that it's going to crash in the next 6 months. But it just gives you some sort of a semblance of an idea of where the market is currently at. So after trying to understand where the market is currently at, I think Howard Marks, just in time, dropped the podcast episode with my first million. I'll leave the link in the description below. But out of that 40-50 minute interview, I think there's just 3 main points that is relevant to today's discussion. First, I think going back to the basic principles of the stock market. The risk in the market does not come from the companies, the securities, or the institution. The risks in the markets are purely behavioral in nature. That when others are imprudent, you should be a lot more prudent. And when others are carefree, you should be terrified. And the second point is that when people always ask Howard Marks, is this a buy or sell? Is this risk on or risk off? The answer is, it's always a mix, and you need to know where on that continuum you stand. And the third and parting advice that Howard Marks has is that when the time comes to buy, you won't want to. So then the natural question is, then what? How should you make your decisions from here? So in my own speculation, I think this topic, especially around a stock market all-time high with a lot of very conflicting and very messy messages, will leave investors confused and lost, and it will be a recurring theme until we see that correction, bear market, whatever it is. But it will be a recurring theme with no good answers. And this is the best that I've got so far. And I've also covered this video topic 2 weeks ago about what would be the ideal cash percentage to hold in this current stock market. But that's it. I think all these rule of thumbs and guidelines are completely contextual. What's more important is to understand your own personal general philosophy and what undergirds your investment decision. So this is my own philosophy. For myself, I do believe that anyone under the age of 35 to even 40 is perpetually underinvested. And this whole conclusion is being drawn out because I believe that you wouldn't hit your peak earnings capabilities until you reach your 40s. So before that, I think whatever amount of wealth that you have amassed will probably be considered pretty small in the grander scheme of things. But of course, you should always start investing earlier and allow compound interest to kick in. So especially when you are very far away from this ideal 35 to 40 years old, the further you are, the more you are perpetually underinvested. So a lot of all these tweaking between should you hold 5% or 6% cash, 15% or 16% cash, I think all things considered, if you are able to tolerate the risk, if you're 100% exposed to equities, which is like in my case, I think I'm fine. That's my own general philosophy, of course. And yes, not forgetting on an entire net worth basis, you would probably have cash, you might have exposure to home equity and things like that. So a lot of all these are contextual in nature, but what's more important is to understand what is your own plan. Secondly, I think I always encourage people to not try to time in and out of the markets because you think that you have superior knowledge. Mainly, not so much because I don't believe you're smart, but more so because I think you're too smart. And personally, I've seen very, very smart people being able to time out of the market, but the bigger problem is the timing in. There are a lot of psychological effects that will affect even the smartest of our kind. And the last point is that for myself, it's something relatively new that I'm experimenting with, which is opening up myself to the idea of rebalancing. And as like I alluded previously, I believe that I'm perpetually underinvested, so I want to remain overly exposed to equities for the earlier part of my career, and I rarely try to step into the bond market. So for myself, I think because I already have an existing portfolio and some of these names have already grown by a pretty significant extent, rather than saying that I want to trim some of these positions to hold cash, maybe I do have other candidates or other stocks that I wish to have exposure in, so I've just rebalanced them. I'm selling some of these existing stocks to allocate to new names. And in this case, it just means that my overall exposure to equities will still remain, but the composition will change from time to time. And of course, the second part is the idea of I'm trying to build a stronger cash buffer. Not so much from just trimming existing positions. In fact, as much as possible, I try not to trim my existing equity positions, but more so due to the additional income streams or the retained earnings that I get from different areas. And then that will help channel to build that stronger cash buffer. And just to share, personally, I'm currently sitting at roughly 5.6% in terms of cash position on my portfolio. So 2 weeks ago in that video, I shared that my cash position was more than 6%, but it has came down slightly because I actually bought a little bit more of my existing positions. Because I do foresee myself that if I don't put in this short-term immediate goal, I can't control my own cash deployment. So to give you a little bit more perspective, and also in the name of transparency, this is the current most latest breakdown of my portfolio. And I've also took a screen grab of my latest August buys and sells. And you can see that I've already started my first round, or in fact, second or third round of rebalancing. I actually sold TSMC and reallocated to other names. And in the most recent 1 to 2 weeks, I actually added to my position or exposure to Lululemon. And I've been seeing some comments here and there asking me about my position or my thoughts. Here you have it. I'm still adding to them. And moving on to the last point that I wish to share is that I think this time has also felt slightly different. And I know it's a very, very precarious and a very dangerous term to use in the stock market, saying that this time is different. But for myself, I think when I've been in this whole last 4 to 5 years trying to build out the portfolio, I've always not been afraid of not being able to find opportunities. Because clearly we know that over the last 4 or 5 years, we have seen huge V-shaped recoveries in the US market after the pandemic, and maybe a little bit more of the U-shaped recovery during the 2022 inflation bear market. And in 2025, earlier this year, it was a very V-shaped due to the Trump tariffs. But not forgetting the fact that when you are talking about investing, opportunities is on one hand a very important part of the equation, but the second part is really the idea of being comfortable, having the conviction to hold through. And for myself, I have always had 2 major markets that I can play in, which is the US market and also the Hong Kong Chinese market. But we have seen that actually even in the last 2-3 years, the Hong Kong market has always been in the bear market, especially a lot of all these Chinese Hong Kong tech names have been unfairly beaten down for a very large extent. But we are seeing some signs of very strong recovery over the last half a year, 1 year. And opportunity seems to be shrinking very, very quickly. And I don't have some sort of a very good safe haven. Okay, I shouldn't use the word safe haven because they're still equities at the end of the day. You are still taking on a lot of risk to invest in such equities. But in my case, I do view them as if you have very low valuations, it means the expectations are low and you have a greater deal of margin of safety. But once valuations all start to expand and when things start to look a little bit frothier, then you see that your window of opportunity or your circle or your universe of potential names you can invest in starts to shrink. And in this case, I think what's so different right now is that we are seeing a lot of recovery, and that will inevitably lead to lesser great ideas in that case. And we don't want to force a swing in this case just because you want to put monies into the market. Although I think I still believed that we can always identify different opportunities in different market cycles. The more important thing that I wish to keep a note here is that I don't want to deploy capital just for the sake of it, because I think that we are perpetually underinvested, so I want to keep investing, but more so be more strategic, at least in the immediate term, within the next 1 to 2 months, to build up the cash buffer first. And which backs to the point again that every dog will have its day, and in 2025, on a total returns basis, the S&P clocked in roughly 9-10%, while other markets that are not so high performing, at least they don't give off that impression over the last 5 years. You can see that Singapore clocked in over 26%. The Chinese and the Hong Kong market also clocked easily double digits, 25-30% returns. And you can see that a lot of catch-ups are coming in. And of course, as an investor, if you were to ask me, of course, I would like to buy stocks when they're cheaper, not when they have already caught up and start to become a lot more expensive. And I think just the last point that I wish to add before I end is that there was this very interesting observation. I'm saying that it might potentially be a rough year so far for the quality compounder connoisseurs. So if Costco actually turns south, I think it's Armageddon. And with that, I'll see you in the next video. But more importantly and hopefully, I'll see you guys on the moon. Goodbye.